Well, I show it's one after, and I want to be respectful of everyone's time, so let's get this started. Good afternoon, everybody. My name is Adam Petricoff. I'm the managing partner of VR Business Brokers here in Charlotte, North Carolina. And today I'm super excited to have Rob Snowden, who is the founding partner of SouthPark Advisors, a local valuation firm also based here in Charlotte. Before we get started, Rob, welcome. You just want to give a quick overview of yourself and your firm.
Yes, certainly, Adam. Thank you for having us today. Our firm is SouthPark Advisors. We're an independent business valuation firm here, headquartered in Charlotte, North Carolina, with offices in Rochester, New York, and Phoenix, Arizona. What does it mean to be independent? Valuation is our only business, so we don't accept contingency fees. We work solely on an hourly basis, and our number one priority is to provide our clients with reliable, independent, objective advice on the value of their businesses. So thank you for having us.
That's great. And that's a good background. And so let's jump in. And now that Rob has given his background, let me give my little disclaimer here that we are. Hopefully, there we go. So this is general information purposes. If you have something specific, please follow up with either one of us after. And what we're going to be talking about today applies to a small business doing 2, 3, 400,000 revenue, all the way up to a $100 million business. These concepts are the same. The numbers and the zeros are just different. So let's show you the overview of what we're going to do today. Why you need evaluation, understanding the components that drive value, and some basic questions that both Rob and I hear all the time about who are these valuation experts? A lot of people don't know valuation experts. As you can see, Rob is live. He's a real person. It's a really, really important report to have in your toolbox as you, as a business owner, or are considering an exit now or many years in the future. And of course, we'll end it with questions and answers. I would encourage you, if you have any questions, feel free to put them in the Q&A section or the chat section. I will pull them up and ask them either during or throughout when the best time seems available. So let's jump in. And I do want to just add one comment. When we talk about evaluation on this discussion today, we're talking about a professionally paid valuation that someone is paying for. I'm not talking about a free valuation or something you can do over the internet, 123valuation.com or something like that, because there's all kinds of what I call software programs out of there. And there are some good ones out there. I'm not knocking the software programs that tell you the value of a business, but we're really talking about professionals like Rob and his colleagues who literally go painstakingly through the financials of a business to really come up and calculate the valuation of the subject they're studying. So what are the reasons why someone would want to get a valuation, Rob? All kinds of people must come after you. So let's talk about why someone would want to get a valuation done.
Well, I can tell you a common theme is that, we're approached by a business owner or owners that are ready for retirement, and they're looking to exit their businesses. They've heard that my business is worth 3 to 5 times EBITDA. And they've got $1 million in EBITDA, and they're asking our advice on whether that's an accurate measure to value their business. And my reply is always, well, is it 3, 4, or $5 million, and do you want to leave potentially $1 million on the table by not getting a professional valuation? Because at the end of the day, business valuation is about the facts and circumstances. I was raised in the industry and worked with a nationally recognized expert that said, Rob, you can make the numbers say anything. If you want a $10 million value, I can find a way to get that value. It doesn't mean that it's going to be realistic. because I can manipulate math. So at the end of the day, the foundation for any valuation is common sense and good information, and basing it on economic realities, and not, like you said, Adam, churning it through a software program. We're lucky we aren't in a virtual reality business yet. So, the work that we do is very, very much, we're problem solvers, and we're out there trying to figure out what the value is, and basing it up with the real numbers.
So we've got some other lists of reasons why people come to valuation experts like Rob: estate issues, partnership issues, divorce, you name it, ESOP. I know there's lots of ESOPs going on out there today. My comment from my seat is two things about valuation. One, when we ask an owner what they think the value of their business is, I have almost yet to meet someone that does not have an overinflated worth of what their business truly is worth. Typically, it's somewhere between 1.5 to 2 times. If they think it's worth 2 million, it's somewhere worth between typically $1 million and $1.5 million. Almost never have I had someone say, I think my business is worth 2 million, and we go back to them and say, no, it's actually worth 4 million. Rob, you want to talk about that? How very few people actually have had a valuation, and this is a new experience for them.
Well, I would say this, Adam, as a business owner myself, you're very emotionally tied to what you've created. And if you've been in the business a long time, your connection to that business is not only has emotional aspects, but it's very much a lot of times tied to your identity. We work with a lot of high net worth individuals and business owners that, and I'm working with one right now, 80 years old, that still can't grapple with the idea of retiring. He's done this business and built this business his whole life, and what am I going to do afterwards? And every time we try to help him along, he retracts at the idea of retiring. So at the end of the day, you're going to make your own decisions. But like you said, there are quite a few different reasons to need a valuation. A lot of time is that the value of a business represents 60% or more of the retirement income that someone's going to need to ride off into the sunset. So it's a very important asset. And, not knowing what the value of your business, it already puts you in a secondary type position, because you can't plan to take care of something, and you can't plan for a future event without understanding it. And if there's one thing that I could say to business owners out there, is start your planning early. We're working with a group right now. They're all in their early 50s, and they've been working on their exit plan for 10 years. That is very much the exception to the rule. Usually it's, I'm 1, 2, 3 years away, and I'm ready to go. And that puts you at a disadvantage, because you want to run to the door. You're willing to take a discount to get to retirement a lot of times. And that's usually driven by, a birth of a grandchild, a major health scare, or you're just burned out and you want to go. But it can take, 6, 12, 18, even 24 months to exit your business. And, you're at the mercy of things that you can't control, like changes in the economy.
Yeah. And I like to tell owners when we're talking to them that these are illiquid assets. It's not like you own Microsoft stock. You can go sell that tomorrow. A privately held business, as you just mentioned, could take up to 24 months to sell. Yeah. Yes, we of course want to sell them sooner, but these are processes that take significant time, energy, and resources to get completed. So let's jump in. Let's go a little deeper. So these are the reasons why someone would get a valuation. Talk to me a little bit about this next slide here, if I can get my computer to work with me. I went too far. What are the things that drive value from a valuation perspective?
Okay. Well, we get this question a lot from individuals that are very incredibly astute at running their businesses, but they're not necessarily financially sophisticated, so they don't understand how those profits turn into value. So really, at the end of the day, the value of any asset is valued based on its underlying cash flows. But if you want to look at it in totality, there are really three components to understanding value. The first is, like I've said, cash flow. What's the realizable cash flow of that business? And you have to think about this in terms of the buyer's perspective, because it's there's the realizable cash flows to the business owner, but how much of that can be transferred to a buyer? For instance, if you've got key customer relationships, you may or may not be able to readily transfer those, and that represents a risk factor, and hence, all things being equal, would reduce the value of your business for a key customer concentration risk. The other example I like to give here, Adam, is that buyers are only going to pay for cash flows that they can validate. So for instance, if you're a bar owner in a better time than we are right now, cash, it's not uncommon for bar owners to sweep cash under the table. And say you've got a bar owner doing that to the tune of $10,000 a month, $120,000 a year. If I can't verify that that's actually happening as a buyer, I'm not going to be willing to pay for it. So there's this dichotomy between, obviously you want to reduce your cash flows so you can minimize your tax burden while you're operating your business. But as you get ready to exit your business, the goal is to shift that mindset towards showing more of your cash flow, so it can be validated, and you can maximize your value at exit. Now, another thing that comes into key play is your business, and is it mature? Is it growing, or is it in decline? And again, growth you're paying for future growth. You're paying the value of the business is based on its future growth expectation. So the example I can give is, I'm valuing a business right now that has pretty much saturated the Charlotte market, but they're moving into a new market. The historical numbers reflect the mature cash flows from the Charlotte market, but they haven't yet really fully realized their full potential in the new market. So where they're going to be growing 3, 4, 5% here, they're going to be growing 10, 12, 15% in this new market by virtue of it being less saturated. So that plays a key. And then finally is risk. What are the overall risks that I'm not going to fully realize those cash flows? And this can be significant. And the example I like to give, Adam, is that years ago, I valued a construction company whose sole job was to build stores for a big box retailer. 95% of their business was building these stores. And they poured a concrete floor, and the corporate engineers came in to take a look at it, and they said it's not correct. And they asked them to re-pour the floor. And they didn't re-pour the floor. And 6 months later, they were out of business. They were blacklisted from building stores. So these risks are real. So you could have maybe, it's not uncommon, to see a business owner that started their business based on an idea they had, or a product or service they've built around something they experienced at a previous employer, and now that previous employer is their biggest customer, and it can be 30, 40, 50, 60% of the business. So, key customer concentrations, key person risks, these are real and play into the value equation.
It's great. And it's interesting. Rob handed me this slide and I said, these are almost the only three things that matter to a buyer. I always challenge sellers to put your buyer hat on. Look at your own business from a different perspective. What kind of cash flow can a new buyer expect? Are you growing? And what is the risk? It's all about risk. When someone's buying your business, they want to do everything they can to minimize the risks. So how you can de-risk your business as you get closer to going to market is extremely, extremely important and makes you that much more attractive to a buyer. One thing I just want to point out on this slide that is not on here, that we get asked all the time about, which is potential. Oh, but we have so much potential. This business, we could be doing twice as much if we just, did X, Y, and Z. And I always tell people, buyers buy based on cash flow growth and risk. And Rob, how do you answer that question? Well, it's got so much potential.
Well, potential is one thing, but it's got to be, realizable potential. It can't just be pie in the sky.
Yeah.
For instance, this company I'm valuing in Charlotte, middle market company, like I said, they've got a historical track record of performance. They're a top flight company expanding into a new market, which they've already been in for 5 years, that was growing by double digits prior to COVID-19, that's seen some retraction as a result of unforeseen conditions. But even in that deal, there are earnout provisions to say, okay, we're going to pay you so much, and then going forward, we're going to pay you additional based on the performance over the next 3, 4, 5 year period. So it becomes a point of negotiation as to how much risk the buyer views in those cash flows that have not yet been realized. And they will often discount them, or there will be a negotiation to split that risk.
Well, and you bring up a great point, which segues right into our next conversation, which is, you mentioned COVID-19, and there are external and what I call internal factors that a owner can control. And so talk a little bit about the differences. Obviously, we've got them listed here, internal, external, but talk about it specifically from a valuation perspective and how you as a third-party valuation professional look at these factors.
Well, certainly, value is based on a number of external, internal factors. However, with the external factors, we don't have a lot of ability to influence those. Like we can't control what competitors do. We can't control what's happens economically. We want to try to protect ourselves as much as we can against those risks. But at the end of the day, we're pretty much at the mercy of what happens in the economy. If somebody had said in March, oh, by the way, the United States and the rest of the world's going to be hit by a pandemic, that's an event outside the normal, in the tails of the normal distribution, that affects everyone, and there's not much we can do about that. But we try to mitigate those risks as much as possible. But the really important ones we want to focus on, the true keys to value, are internal factors like our products and services. We can control that. If we got products that aren't doing well or have become aged or outdated, we can get rid of those products or services and introduce new services, or we can use technology to streamline our operation, do more with less, and hence drive value. The real important one is, kind of thinking about it in terms of profitability and growth. A business owner should be always thinking about, and this should be a long-term perspective, is how can I increase my revenues, decrease my expenses, or use some combination of that to increase my cash flows and drive additional value to my firm. And you always got to be looking at the growth prospects. But the good news is in the case of the business owner, where they can create the most value for their companies is by looking at their overall profitability and their growth prospects. But that's why it's important for business owners to concentrate on, instead of working in their business, working on their business and managing that long-term growth expectation, managing the day-to-day numbers with a long-term growth of maximizing value, is really, really detrimental to say, well, for instance, I've done it this way. I've done it this way my whole life. I don't have any other managers in place. I'm going to run this thing to the end. One of the biggest questions we come up when we're doing employee stock ownership plans is, what's the succession plan? Who's going to take over the business when you retire? In some cases, management has done a good job of building out their team and they're capable individuals that are going to take over. In other instances, they're in the process of doing that and they're going to do it over the next 3, 4, or 5 years. But what that means is the business owner that's trying to retire is locked up for at least 3 years while that transition's taking place. So one of the more important items in being able to transition your business to a buyer is, if they're not going to run it, somebody has to run it, and is there capable individuals in place.
So Rob, let's everything you say here is really good. Like you mentioned, every business owner was focusing on their business, and then boom, we all got a left hook or an uppercut, whatever you want to say, this year. So how should they be focused on getting back to where they were pre-pandemic, and how that could impact the value of their business? Because clearly we're all dealing with things we've never dealt with before, and yet there are still plenty of owners that want to exit, right now or next year. So, talk just a little bit while we're here of what we're dealing with today, and what owners should be thinking about relating to coming out of this on the other side.
Well, what I've learned, I've been in this business in 1996, and I've seen a number of economic events and seen their industry-wide events, such as the fiber optics equipment collapse, the dot-com bust, and things like that. There's no substitute for experience and seeing things like that. This is clearly a temporary condition. Our economy's bounced back. But I think what's important to note is that it may feel like I'm the only business that's failing, or I'm the only business that's having difficulty. But the reality is that there's winners and losers in every down market. The example I give is that if you're trying to build a pool right now, they're booked into next year. They're booked 10, 12 months out, because those that realize that they're not going to be able to travel and they have kids are trying to figure out how to bring that leisure time to the home. So they're building pools like crazy. And so pool building businesses are way, way sky high right now. But I guess my advice would just realize this is a short-term, impact. Obviously step conservatively, don't make any aggressive decisions, but be stepping forward with the understanding that eventually things are going to improve, because they will.
And everyone knows what's going on. This is not a situation where people aren't aware of what's going on. Buyers are aware of this, bankers are aware of this, attorneys, other professionals involved in the deal transaction are absolutely very aware of what's going on. I just want to sort of highlight one thing on here, the systems and processes. As we deal with buyers today, I can't tell you the attraction a business will get if they have good systems, i.e. a good CRM, something that they can readily pull out customer data, or even internal employee data, making sure you have good systems and processes that are easy to follow or easy for someone else to follow, that it's not all up in your brain or it's not an Excel spreadsheet. It's got to be a step past that again, de-risk your business for someone else. We sold a business last year, and they had the most awesome CRM presentation. They could pull up anything about any customer over the last X amount of years. The buyer called me after the initial buyer-seller meeting, and he said, that was the coolest thing I ever saw. I was interested in the business, but I am so much more confident in this business because of what I saw. So I just want to share that to the owners who are on this call. Having systems and processes that are easy for someone to come in and adapt to are extremely, extremely important.
Well, certainly one of the things we come across with companies that are 5 million in revenue and under, right down to Main Street businesses, is accounting. Accounting is rough. What happens a lot of times is a small business gets started and it grows, and the internal bookkeeper becomes the controller.
Yep.
But the reality of that, and the problem with that, is that person is not sophisticated enough to do some of the things that you're going to need to be able to do, improve once you get to a certain size. And we often spend a lot of time untangling, for lack of a better word, internal accounting to get to the value of the business. And again, it's another point of, if I come in and the buyer and I can't get comfortable with the financial statements, it does impact the price that I'm willing to pay.
Completely agree. And we'll give a shout out to Jeff Haybrook and his team at Lucrum Consulting. He's on this webinar, and they work with owners who specifically need help making sure their financials are in the best position that possibly they can be. We're getting some questions in, both to the Q&A and to the chat. I want to encourage more people. Feel free to write a question while we continue to go along here. So a lot of people, like I said, I think a lot of people don't know a business broker personally, or they don't know they even exist, amazingly. Well, less people probably even know a certified valuation expert like yourself, Rob. So I'm just going to ask some questions that I get all the time, and feel free, some common questions that you may have. How often should someone get a valuation?
Well, it depends. It depends on the situation, but honestly, if you're in a mature business, that valuation might be good for a year or two. If you're in a growing business, it could be changing every 6, 9, 12 months. So it really depends on how fast your business is growing and the type of business to understand how often you need it. But anytime your business your cash flows are changing materially, like if you did 150,000 in cash flow in year one and you're at 250, your valuation at time zero is no longer probably reflects your true cash flows.
And are there different types of valuations? Do you handle a $300,000, $400,000, $500,000 company the same way you handle a $75 million company? I know there's different levels, but talk about that at a high level here.
Fundamentally, companies are valued with a slate of methodologies. It's what changes is the level of complexity. And believe it or not, some of the small businesses can be more challenging to value than the large businesses. And the reason is the large businesses have a greater level of financial sophistication, and they have a controller and or a CFO that you can interview and talk with and get an understanding from a financial perspective of what that business is actually doing. Types of valuations, yes, they're very different types. When you're selling a company, that value is much different than if you're doing estate planning and trying to gift ownership to sons and daughters that may be the next generation to take that business over. The other thing, just thinking about that is that, there are different levels of value. Fair market value represents a financial buyer, someone that's going to come in and buy the business and operate it for a financial rate of return. They're not going to necessarily change much about the operations, at least in the near term. But then there's also strategic value, where the buyer is typically an industry participant, but in order to get that strategic value, you have to have something that is of value to the buyer, a system, a process, a market territory. If you're an engineering firm, it could be personnel. Yep. There has to be something that the buyer places a higher price on than a financial buyer. And what's tricky about that is that the buyer isn't going to tell you. They're not going to reveal that to you. And that value is specific to them. So it becomes a exercise in trying to estimate when you're negotiating what the potential premium would be to be able to get there. But private equity groups that do roll-ups, they're financial buyers, but they have they're looking for a strategic exit. So there are different values.
Correct. And so before we jump into some Q&A, and thank you everybody for putting them into the Q&A or the chat. So Rob, from your unique seat in SouthPark, Charlotte location, right there in that office.
Okay.
You're talking to the owners. There's one thing that they should be doing to work on their value. What would that one thing be? And I know that's not an easy question. You just gave us the three things that are the most important. But what's one thing that an owner can walk away from this conversation and say, okay, I need to make some progress on that in 2021?
Well, Adam, I'm going to expand that to three things because I've been valuing businesses for 22 years. And what's been amazing is I've valued mom and pop businesses to companies $1 billion in revenue, both public and private. And there are three attributes that all business owners possess that are successful. One is that they're serving some type of market niche. They're doing something that no one else can do. And it's amazing what I've seen in my career. The second thing is that they grow conservatively. They don't try to take on too much. They're almost always lagging behind the curve, and they're maximizing their people and their processes and to the point where now I've got to add. So conservative growth. And three is being risk averse in terms of that. They're conservative with their debt structures. A lot of businesses I've looked at in Charlotte, the business owners, and these range in all size companies, they do not like debt. But what I can tell you is debt is cheaper than equity. So having a certain amount of leverage on your books actually will improve your value.
Yeah. So just again, for those of you at home listening to this, be conservative with debt, grow conservatively, and find a niche. Yeah. You don't want to be one of 6,000 in Charlotte doing the same thing. You want to find that niche. Riches in niches is the expression.
That's right.
So let me go over to some questions here. We've got a question. What are you seeing? And I think this is probably towards both of us. What are we seeing on the landscape for deals right now? And I'll add to that, and its impact with value from your perspective. So let me take a first shot at that. And look, it's been a brutal year for Charlotte, for the country, for the world. I'm also here to tell you that deals are getting done. Absolutely. There was a pause in March and April and May, but late summer, early fall, we were as busy as we've been in a long time. It's slowed up now between Thanksgiving and Christmas. We understand that. We expect, as this vaccine's rolling out, it's going to be a very, very active year next year. Rob, from your seat?
Yeah, I would agree. We do a lot of buy side and sell side ESOP advisory work, and we're busier than ever. And we do not see it slowing down either. In fact, we don't see it slowing down for a number of, 3, 4, 5 years. I think we finally have you hit the silver tsunami. Individuals are looking to retire, and they've reached the point where they can no longer wait. And I think that is going to be the biggest driver of our business over the next 5 years, at least, maybe 7, as well as, we do have some pending changes in the tax law on the horizon. And depending on how that goes, the last time I saw that happen, I was with a company that grew double digits for 12 years straight. So the environment is good. It's very good right now.
Yeah. So, I mean, what I tell people, and there are some buyers on this call right now, so they're thinking of from the opposite perspective. What I say is, if you got to be ready. There's good businesses out there. There's some businesses with some hair on them. There's no such thing as a perfect business. But we're blessed. We're in a really good part of the country, the Southeast, Charlotte, North and South Carolina. We're in a good part of the country. People are moving here. So if you own a business, there's all those apartment complexes are going up. They're bringing in these young folks. People eventually are interested in buying a business. So we agree, Rob. We think the next 5 to 7 years are going to be very attractive.
The statistic was in Mecklenburg County, 30% of the housing inventory was purchased by people outside of the state. 50% of those people were millennials.
Amazing. Truly amazing. And let's talk about the next topic that always I get asked, and I know you do. They say, well, look, I had my HVAC business valued in 2010. Have valuations gone up by 30, 40%, or the multiples still the same? And, what I consistently tell people is, unless you're in high growth, SaaS business, software business, multiples don't fluctuate significantly year over year. Maybe you look up after 10 or 15 years, they may have moved. But do you see multiples in specific industries moving much over the next year or two, or even further?
No, I think they'll stay relatively the same. The reason why an HVAC business would stay in a range of 3 to 5 potentially is simply because it's mature. Like the example you gave, a SaaS-based business, you could see 8 to 10 times EBITDA on those really high multiples. And the reason is their recurring revenue streams where once they hit a certain threshold, every dollar they earn goes practically straight to the bottom line. They're big cash flow generators. So that's what drives that. Going back to cash flow, growth, and risk, all a multiple is taking a DCF analysis of those 3 factors and impounding into a multiple.
DCF, for those of you on here, is discounted cash flow.
Sorry, I used a term, use a financial term, but yeah. So when somebody says 3 to 5 years or 3 to 5 times EBITDA for an HVAC business, it could very well fall in that range. If it falls outside that, if it's higher, for instance, they're doing something different than the traditional HVAC business.
Yeah. Another question we have here from someone who's in the manufacturing and heavy equipment, and they're wondering how you didn't really mention FF&E, furniture, fixtures, and equipment, in evaluation. Talk for a second on, because you talk about cash flow and growth and risk. Well, let's say I have $1 million at the time of equipment, or $10 million of equipment, but a lot of that's been depreciated. How does that factor into evaluation? And I know it's a case-by-case basis.
Yeah, it's a case-by-case basis, but essentially in a discounted cash flow analysis, you're adding that depreciation to your operating value, and then you're subtracting your expected level of capital expenditures. And then beyond that, you're also taking into account any additional working capital need you would need to grow your business. But certainly having depreciation is a benefit because you get a tax break.
Correct.
But what happens a lot of times nowadays is you get bonus depreciation or Section 179 expense, and you have to look at the timing of that, because if you've taken a lot of that up front, and depending on the structure of your entity, you could have a big tax liability sitting out there when you go to sell your business. So it definitely plays a role, but you have to understand the timing aspects of it and do the cost benefit analysis. Obviously, you don't want to run out and buy a piece of machinery and start depreciating it without it adding, creating profit for you.
Yeah, and I met with a guy right before the pandemic, and he just bought over the last couple of years, he bought about $1 million worth of equipment, and he had an aggressive and legal accountant that really depreciated a tremendous amount. So he got the benefit, but now that he was interested in selling, he's like, well, I want to get the value for that equipment. And I'm like, it doesn't, you can't do it twice. It doesn't work. You got the benefit. You're not going to get the $1 million for your equipment, because the FF&E that you have is what is in a position for you to get the cash flow. Without those investments in that equipment, you're not going to be generating the type of cash flow which will generate the type of multiple and value on the business.
And generally, if you're buying a manufacturing business, the assumption is the equipment is going along, because like you said, Adam, you can't run the business without the equipment.
Correct.
So,
So, you and I get unique questions all the time from people. This is a fascinating topic. I have read somewhere that less than 5% of business owners have ever had a formal valuation. I actually think that's high. Most people, like you said, they have an asset that may be 50% or as much as 80% of their retirement, but it's tied up into a liquid asset. So if you walk away from this webinar with one thing, it's really trying to understand truly what the value of your business is, so you can make the best decisions on retirement or succession or bringing family in or ultimately selling.
And just to add to that, Adam, really you have to think about valuation as being a fairly critical piece, but you have to understand the legal and tax implications of your planning, your sale, and the time requirements as well, and the accounting aspects. So it's legal, financial, valuation, accounting. All these things are working together to formulate your plan to be able to maximize any of those proceeds that you receive on sale, and then be able to use that into retirement. So it's a big puzzle that needs to be solved. It's not something that you want to be rushing to do.
And it's part of the reason why the first thing we do as a business broker is we work on evaluation. Whether we do it internally or whether we use professionals like Rob or other certified valuation professionals, we want to get that started so they can then go back to their other advisors, their accountant, their attorney, and make sure that they're properly planning. You get one chance to sell a business. We want you to maximize the proceeds, and that obviously always takes in tax consideration, et cetera. Rob, this has been great. Before we end, I just want to let everyone know that we are doing this on a monthly basis, this Contemplating Your Exit series. After the first of the year, we're going to have Andrew Kittleson, who is with UBS. Not only is he a wealth manager, but he's also a certified exit planning advisor. He's been certified. And so we're going to take a perspective, just like we were talking about, Rob. You got to have all the individuals as part of your process. You got to make sure that you're thinking about everything. So you're maximizing the amount of proceeds, you're maximizing your long-term financial plan, your legal, as well as your tax implications. So guys, really appreciate everyone's time and energy today. Appreciate the questions out there. Rob, as always, it's a pleasure. I learn something every time I talk to you, and I now have the 3 best attributes of a 22-year-old valuation expert that I can use with my clients. And if anyone has any individual questions for Rob or myself, please do not hesitate to reach out to us. We have gone out of our way to make these informational and educational. These are not commercials for Rob or for myself. We're here to help. We're here to educate. We're here to provoke you with thoughts that you need to be thinking about as you run your business and ultimately someday make an exit, whether it's 6 months, 6 years, or 15 years. Thanks, everybody. We greatly appreciate your time. Rob, enjoyed it.
Thanks, Adam.
Thank you.